reacting to the market every day, but over time, they realize something is missing. The results are inconsistent, decisions feel uncertain, and the growth is slower than expected. That's because trading and investing are not the same. So today we are honored to have Mr. George Paul to share with you a clear and practical framework to help you invest with greater confidence and clarity. And before we proceed, allow me to make a short disclaimer. Please be reminded that everything that is shared in this session is mainly for educational purposes, and by no way we are providing you advice to buy or sell any securities. You are 100% liable if you make any investment decision. And now, let me introduce our guest speaker today, Mr. George Paul. Mr. George Paul is a financial practitioner and financial coach who has more than 13 years of investment experience and 5 years of working experience in wealth management and financial planning industry. He is the certified member of Financial Planning Association of Malaysia (FPAM) with certified financial planner CFP qualification. Mr. George is the holder of Capital Market Services Representative License, which is CMSRL, and Financial Advisor Representative (FAR) license approved by the Securities Commission Malaysia and Bank Negara Malaysia. Mr. George holds a Bachelor in Finance, first class from Coventry University, UK, and has been actively involved in organizing financial related conference and workshops. With that being said, let us warmly welcome Mr. George Paul to the floor. Hi, Mr. George, how are you today?
Hi, Michelle, and hi to everybody. Um, Happy April Fool today. But don't worry, I'm not here to prank you. So I'm here to share some knowledge with you guys, right? And everyone see my screen. If you can see it, just type in yes for me, all right, in the chat box below. Right. Okay, good. Now, thanks, Michelle, for the introductions. All right, so let me go straight into our sharing today, right? From retail trader to strategic investor, how to build our investment system. Now, this topic today here is to share with you on the mindset and also what are the skill sets that we need to build an investment system for our own self. And it is different from anybody else, right? And I'm not sure how many of you actually listened to my sharing before. And today is gonna be the practical part where I share with you some of it, how to do it. All right. And what you're gonna learn from my today's sharing will be to understand the differences between trading and also investing. These two, often a lot of beginners when they started into the investment world, they were like, okay, so trading and investment is the same, but actually it's different, right? And today I'm going to show you the differences. And secondly, I'm going to teach you how to build a personal investment framework for yourself. And it is at the very front, when we started to do investment, a lot of people actually miss out this step where we need to build our personal investment framework before we actually started to do investment, and thirdly, if we are here to create a system that will align with your goals and also your risk tolerance. And this is very important because okay, can I see your show of hands? How many of you have invested in unit trust before or PRS before? Just put in me, all right, me. How many of you have invested into unit trust or PRS? Right. Those who answer me, do you remember when you do your first investment in the unit trust or PRS? Oftentimes, you will get asked to fill out a form called suitability assessment test, or what they call SAF, suitability assessment form. Have anyone of you aware of that you have actually filled out this suitability, right? Okay, yes, I can see a lot of people say yes. And do you know why? All these asset management company or investment firms, they ask you to fill out your suitability assessment. Have anyone have any idea why they ask you to do so? To collect your data, or you just think that, oh, this is just them doing their job? Okay, risk profiling, yes. Thank you, Fong Yu, right? Yes. So when the fund houses, asset management company, when they do the suitability assessment, they're actually doing your risk profiling. They wanted to know whether you are a moderate, aggressively investors or you are conservative investors. right? But when you sign up for a trading account, no matter which brokers, investment banks in Malaysia, did they ask you about your suitability assessment? Any one of you came across with signing up for the no, right? Okay, a lot of you say no, right? So you see, when we go into investment in stock market and investment into unit trust, PRS, and there's others investment tools available in Malaysia, like properties, real estate, bonds, and whatnot, right? Not everybody asks about your risk profiling. And that's very important. Now, so today, my sharing is to help you to how to build a personal investment framework that aligns with your goals and also for sure your risk profile and your risk tolerance level, right? So without further ado, I will just go straight into my first chapter of the sharing today, which is the trading versus investing in the real world. Okay, can anyone tell me what is trading? In your own terms, what is trading? What do you think? What do you know about trading? Okay, let's just put it into the chat box. Okay, buy and well, Feng Yu, I think buy and sell is common. You do investment, you also need to buy and you also need to sell, right? Sell, buy, shorting, not quite the answer. Okay, not quite the answer. All right, let me ask another question. What do you know about investing? Okay, right, I see some people say short-term leverage. Okay, how about investing? Okay, investing. What do you know about investing? Okay. Now okay, capital gain, long term, right? Okay, so I see the thing, I see the terms here, right? For trading, it's more towards short terms. From a lot of your answers, right? Trading is more short term, investing is a lot more long term, right? Okay. Wow, I get this answer which I like a lot. Trade the price, invest the company, right? All right. Now, okay, you guys are quite correct lah. Huh? Okay, so for short-term trading, because trading we have intraday. So you basically you buy the stock or you invest into the stock based on momentum, or based on the charting, technical analysis. And when we do investing, it's more toward the fundamental of the company itself, or the valuation of the company, right? And are you a trader or are you an investor or are you a both, right? Okay, can I see a show of hand? How many of you here do you think yourself is a trader? Put in one for me. One, number one. If you think you are a trader, put in one. Oh, I see number zero. I don't. Okay, I think maybe number zero is mixture of it. Okay, I haven't asked about mixture ma. Okay, put in one first. Okay, we see there's not many of you here is trader, right? All right. How many of you here is investor? Put in two for me. Two, right? Two. Okay, two. Wow, I can see we have a lot more investors here in today's webinar. All right. How many of you thinks that you are both, a mixture of both? You are a trader and also a investors. Put in three. I can see someone is very smart. You guys know what I'm going to ask, right? Okay, put in three. Okay. All right. Oh, interesting. I see a lot more three compared to one, and also a lot more three compared to two. That means a lot of you think that you are a mixture of both, right? Then when you are a mixture of both, I would somehow quite worried about it because there's this joke. I'm not sure how many of you actually watched this before by a stand-up comedy. I think in India, right? He did this joke, and then I find it quite funny. He said he's an investor, he's a trader, but when the stock start to drop, he tell himself, "Hey, I'm an investor." You start to comfort yourself, from a trader. But when a stock drop beyond your cut loss level and you don't want to cut it, then you hold it for long term, then suddenly you become an investor. I mean, this is a joke, but not nice, coming out from my mouth. I'm not very sure because maybe I'm not a stand-up comedy, right? Right. But that's the saying, right? When you think you are a trader, somehow you're an investor. But when you think you're an investor, somehow you're actually a trader. Am I right? So a lot of people thinks that they are investor. You see, my slides already reflect what you guys, view on yourself. Okay, many people say they are investors, but a lot of them have the behavior that might look more like a trading. So you see, we get a mixture of both in today's webinar. Where a lot of people say, yes, I'm an investor, but somehow your trading or your investment style looks more like a trader, right? And the things here is neither is wrong. Nothing say that you are a trader and you are wrong. We should be investing. And nobody say that, hey, you shouldn't be investing, you should be trading. The problem is that you're not sure what kind of investor you are. And that's the problem. Because if you are very firm, you are very solid that, oh, I'm a trader today. I only do short-term tradings, momentum, string trading, intraday trading. That's it. Then you are quite solid. You are a trader. And if you are somebody who say, okay, I'm a person who invests into stock only based on my research, only based on my fundamental analysis of the company, only based on the valuation that I did of the company. If this undervalue or value of price, right, then I might invest into the company. If you are quite solid that you are somebody who did that before you invest, then you are investors. But the truth is, a lot of people actually get confused. They invest, then somehow they think that, okay, I think investment quite slow. Long term, maybe not my game. Then they start to pivot into trading. So they split their investment portfolio into half. Say, okay, let me try some trading. So I think that's the reason a lot of you is a mixture of both. Okay, might be a true one. I'm not very sure. Right. Okay. Now, in practice, let me just try to break it down to some category so that we can actually do some comparison of what is a trader and what is the investors, right? Now, here's a table. So we put it into 5 aspects. First aspect is time horizon. You guys are quite smart, right? Trading is more towards short term. No, when it's short term, right, it can even goes down to intraday. Intraday means you trade, you buy and sell within the day, right, within the trading hour. Or maybe you are a swing trader, then you can hold on your position for maybe 2 days, 3 days, a week. And sometimes you're a momentum trader, and then you might hold your position for 1 month, 2 months, right? So these are tradings. Yeah, these are trading. For investors, it's different, right? Because investor, we tend to hold shares for long terms, right? I can share with you one of the shares that I hold till today. The longest, the longest period of time my holding onto this company is actually 10 years. I bought it back in 2016, at the age of less than 20 years old. And I still hold on to the stock until today. And of course, the stock make me a lot of returns, and it is a dividend play, right? So I collect dividends from the companies, from the stocks itself. So that one is more towards a long-term game. So investing is more towards long term. You don't really hold on to a share for 3 months, 6 months, and then you sell off the company unless the value justified. Right? For example, you invest into these stocks and then it's undervalued when you invest in it. After 6 months, maybe a lot of investors actually go into the market because they also found out that this company is quite undervalued, and the price is pushed up, by all these investors, to the valuation that you expect it to be within a time frame of 6 months. Then perhaps at this time you think that, okay, it's fairly valued. Why not I just take profit? It might happen. It might happen, right? But not every time. So a lot of time for investors, they hold on to a share for a very long time, right? Like what Warren Buffett said. If you don't plan to hold this share for 10 years, don't actually buy it, right? Don't even plan to hold it for 1 second or 1 minute. I'm not very sure, right? So these are the sayings. But to be honest, don't get me wrong. I'm not here to tell you that you must invest into a stock for 10 years. Because in today's business world, I don't think there is a company that can survive and still be the leaders in the market for 10 years and beyond. You see, because the technology is evolving. So today we see Google. 10 years later, we might not see Google as the number one, right? We might see, OpenAI started to have their search engine and whatnot, and then they started to become the number one, and etc. Right? So we might see that happening, right? So I'm not here to tell you to hold on to a share for 10 years, but at least you need to hold it for a long-term view. And the main focus for trading is about the price movement. So you always see that trader look at chart. right? They look at the candlestick to to try to find a pattern from the price movement. But for investors, we more towards the business value. We wanted to see how valuable is the company, is the business moving forwards, right? So these are the two different mindset for traders and also investors. And I move on to the fourth point, right? The frequency. As a trader, you tend to be more active in the market. You look at the chart every day, then you will do more transactions or more volume, in a year of your investment. But for investors, we don't really trade a lot, And for example, myself, right? In a year, okay, I only have about 10, 20 transactions throughout a year. You see, so as an investor, that's my lifestyle because I don't like to monitor the chart every day. I have my job to do. I have my work to work on. So these are the things, right? So this is a comparison of trading and also investing in practical and different mindset for same stock. Let me give you an example here. Okay, it is not about the stocks that decide whether we should be trading or we should be investing, because it is from us as an investor or trader to decide which style or which investment methods that we wanted to do with that stock, right? So let me share with you. If you are a trader, these are the mindset that you might have, in your mind. Is there a momentum in this price, in this stock? What is my entry price? Where should I enter? Where is the breakout, and then where should I enter? Where is my stop loss? As a trader, they always have the risk management mechanism where they have a stop loss. If the stock fall below certain level of the price, they will cut loss, right? So this is the mindset of trader. Now, next we go on to investors. What is in the mind of an investor? They think about, is this a quality business? See, so when we look at a stock, we are not looking at the price chart. We are not looking at the stock code. We are looking at the company itself. Is this a good company? It is a quality company. Is it reasonably valued? See, because sometimes when the company is good, but the valuation is beyond good, you see, when the hype in the market, right, in the let's say the stock market, it'll drive up the price of a company. And oftentimes when we see this, right, then we'll find, hey, this stock is overpriced, and the valuation, for example, a Malaysian stock, for example, you might see at a valuation of 100 times, 200 times. But is the company really that good? Or is this valuation something that you are thinking to enter? I think that's something to ponder with, if you are investors, and to ask yourself, can it grow over time if I invest today? Right. So this is very important. These are the different mindsets with trader and also the investors. And mindset matters more than the labels. Because a lot of people lose money not because trading is wrong or investing is wrong, but because they mix both without them knowing it. Okay, let me give you an example. Okay, as a trader, your goal is to capture the movement. Okay, not to build your wealth over time with the company or with the stock. Now, this is one of the key differences and key mindset shift that we need to have. And for example, your risk focus. For a trader, your risk focus is to protect each of your trades, because you earn based on all the single trades that you have, and you combine everything, that's become your ROI or your returns throughout the year. But for investor, your risk focus is to grow your capital. You see, is to grow your capital responsibly. That means that if you think that this company is good, it is undervalued, then you start to accumulate your position into the company instead of you invest one lump sum. See, so these are different things, when it comes to trader and also as an investor, right? And the key question here is, if you're a trader, you ask yourself, what is my setup? You see, I don't have an example here to show you here, but imagine yourself looking at a chart, at a stock chart. As a trader, you look at the chart, you already see the patterns. So okay, where is the breakout? where is my entry point, and what price, this stock will go, where's my expectation, where's my target price, and where is my stop loss, what's the ratio. Now this is what we call the setup. You need to have all this setup in place before you enter into the position for a trader. And for investor, your key question is not about the setup. It's not about, hey, where's my entry level, where's my target price, where is my cut loss, where's the breakout, what is the pattern, it's not like that. For as an investor, your key question is, what is my thesis? When we talk about thesis, it's not something you do for your master's degrees or your PhD. It's something that, what is convincing you to invest into the company, like a research report. Have any one of you read research report from investment banks or brokers? Any one of you, do you like to read reports and the research reports from investment banks? Okay, let me ask, not and how many of you like, how many of you do actually read research report? Wow, somebody said too long. Okay, ask AI. You can try. Now, I see. Wow. See, just now a lot of you tell me you are a mixture of both. You're investor and you're a trader. Yet you don't really read research report. Then I think that you guys are very smart lah. Then you know how to do your own research. But if not, there's actually a place where you can look out for research report, which is My Bursa, right? You can go on to My Bursa, log in account, search for the company, then you can get the research report from the My Bursa. I used to read research report from there as well, right? And sometimes there are others providers or your brokers themselves, they will give you the research report of certain companies, right? So this is very important. Now, why I ask you to read research report? It's very important not to read the report so that you know what to invest. Is to read how they do their research about the company and to give you some insights of something that you might miss out, doing your own research. So that's very important, right? Now, after we know what is the differences between the trader and also investor, let's move on to our second module, right? Which is to know yourself before you build a system, right? Because before strategy, we need to know what we want, right? And what I can tell is that copy somebody else's strategy without understanding yourself is, I think it's one of the fastest way to lose confidence in investment and also the discipline in investment. So that's very important. And what do we need to know about ourselves before we actually build a strategy to become an investor? Oh, before I move on, I want to ask a question. How many of you here, after listening to the traders versus the investor, you are ready to become investors? Put in yes. Okay, how many of you are actually ready to become investors? Or you think that trading is something for me? Okay, say yes. Because if you are not saying yes, the rest of the sharing will not be suitable for you anymore, because this is towards how to be an investor instead of be a trader. Okay. Thank you everybody for saying yes for me. Right now, before we have the investment framework and all the strategy, let's know yourself first. Can I? I'm going to be just like a counselor. Okay, how to know ourselves better. First of all, we need to know our goal. Why we want to invest. Okay, now when it comes to goals, there are a lot of different goals, the different things, right? I will elaborate later. Okay. Now, secondly, you need to know about your time horizon. What how many times you have how long do you have to do investments? Like, for example, you are in your 20s, now you have more than enough, right? You have 30 years, 40 years, 60 years to do investment. But if you are at the edge of 40s or 50 or closer to your retirement age, then your time horizon might be different compared to somebody who just came out from universities, right? And that's very important. Now, the third one, you need to know about your risk tolerance level. Now, for those who have done the suitability assessment test, back then when you invest into unit trust or PRS, congratulations, because you already have some idea of your risk tolerance level. You know how good you can manage your risk, right? And the fourth one, your personality. And this is something very important because the goal, the time horizon, the risk tolerance, all these three can be measured or can be crafted out, with tools, with some template. But your personality is something that we cannot craft for you because you are special to yourself. And I am also special. I have my own personality and it's not similar to you. So your personality is not something that we can craft for you, but that you have to identify and to understand yourself, right? So with that, let me share with you one by one, into the goal first. You need to understand your goal. So when we ask about goals, this is the key question you need to ask. What are you investing for? Okay. Are you investing for capital gain? Are you investing for passive income, to be your retirement income? Are you investing for wealth preservations? Are you looking to preserve your wealth, towards the three generation, four generations down the road? And what are your future milestones? Are you looking to have your first house? Are you looking for your retirement, at 50 years old? And maybe you're building the education fund for your children. And these are the goals that align, when we do investment. So very important, you need to understand yourself. What is your investment goals? You can have multiple goals, guys. Don't get me wrong. You are not going to only have one goals. You can have multiple goals, right? For example, um, let me give you an example. If let's say you're at the age of 28 or 30 years old, let's put it easier. You're at the age of 30 years old. Now, can anyone of you share with me what likely will be the investment goals of a 30-year-old working adults? What likely will be his or her goal? Okay, capital growth. Can we be more specific what he wanted to achieve in his life? Education fund. Okay, maybe this guy is a newlywed, so he wanted to build a family. No, so he need to build for education fund, right? House deposit. Okay, a 30 years old guy or a girl, I think, is a good time, to get your first house, to settle down, right? That makes sense. Merit fund. Wow, Cairo, thank you very much. I think these days we don't see a lot of people married at the early age, right? So I think 30 years old might be a good time. Maybe he is looking for to have his wedding at the age of 32, 33. So he's looking to have this merit fund, a short-term one. Okay, dream car. Well, yes, dream car is also our goal, something that we can build. Passive income, capital, wealth preservation. Yes, I think everybody of you here, your guys are very smart. I think maybe those who are answering are those who are at the age of 30 years old. So you guys know pretty much what this 30-year-old guy or girl he wanted, right? Right now, you are right. So these are the goals that you wanted. So put it down. When we want to understand ourselves, just put it down. What is the goal you want to have? Like for example, first house deposit, right? When do you expect to get it? At the age of 35, then you have 5 more years to go. Tomorrow, then you don't have any time, right? Or 2 years later, then you have another 2 years for you to build your house deposit. And you need to calculate how much is it. Okay. For example, let's say you're at the age of 30. You're thinking to get your first own stay house at the age of 35. So you have 5 years to go. And when you have 5 years to go, then you start to think, what is the amount that I need to have, for this uh, installment or the house deposit. So you calculate, for example, you buy house, you need to pay 10% down payment, pay your legal fee, pay the stamp duty. Maybe from there you get about 18% or 20%. So from there, you need to see, okay, to achieve the 20% house deposit for these 5 years, what is the range that I can get? Okay, give you an example. If you're looking to buy a 1 million condo, a 20% deposit means 200,000. Can you achieve 200,000 within 5 years of time to get this house? Okay, if you think you can't, then try to lower down, your expectation. then maybe you say, okay lah, instead of buying a 1 million condo, why not I buy a condo a little bit more farther, a little bit more further, far away, at the price of 500,000. Okay, so for a 500,000, your house deposit of 20%, then you might only need 100,000. 5 years time to build 100,000. That's make more sense to you. If that make more sense to you, then yes, your goal is to buy a 500,000 condominium with a house deposit of 20%, right? Don't overburden yourself with, no, I need to have a 1 million condo, but you can't achieve that 200,000 in 5 years. That's the thing, right? So this is where our goal is, and this is very important that we all understand our goals, right? And this is one of the example I can share with you. Okay. Now, secondly, it's about your time horizon. Why we need to know about the time? Because in our personal investment framework, the system, it must also match with our time and also our risk. So for example, if you have a shorter time frame, then the flexibility or the risk that you can take is actually lower. But if let's say you have a longer time horizon, for example, you are building for your retirement, that means you have about 20 years, 30 years to go. Then you have more room for volatilities because you know that after the drawdown, then it might get back up, right, and go on to grow the portfolio of yourself. So different time frame, you have different risk management level. And risk tolerance is also both the financial ability to take risk and also the emotional ability to handle fluctuation. And this is often neglected by a lot of investors because they only think that, okay lah, I have the financial ability, I'm rich enough, so I can take this risk. But somehow your emotion might also affect, your decision during the investment period of time. So that's very important. When we come to risk tolerance, it's always about your financial ability and also your emotional ability. Okay, I see a question there. Ishan, you can put in your question into the Q&A. There is a Q&A, so I will answer it together with our moderator at the end of my sharing. All right. Okay. Now, which type of investors are you? Now, this is more towards your personality. Okay, your personality. So, are you a person who like action and frequent decision, or are you the person who prefers structure and also long-term planning? Okay, and if you cannot sleep even when your portfolio drops 10%, okay, or you are comfortable holding through the volatility, okay, and maybe you're a person who enjoy analyzing businesses more than the price chart. Now, this is more towards your personality. Which type of people are you? I can only show you some of the example here, to understand which type of people you are. And to clarify that, risk tolerance level is not just a questionnaire result, okay? Because it shows up when the market drops and you still have to stick with your plan. So risk tolerance is actually the guidebook when you do investments, right? So if let's say you are a person who like action and those frequent decision, then perhaps you are a more short-term a trader. Okay, then you know your personality. You are more tilted towards the trader path. But if let's say you're a person who prefers structure, long-term planning, you like analyze business, you more than price chart, then yes, okay, your risk level and also your personality is more towards the investor part side of the game, right? So this is very important to understand our risk profile, our time horizon, our goal, and also ourselves to build a system for us, right? And until here, can everybody clear? And can you catch up? Okay, I believe you guys can. You guys very smart one. Okay, good. Now, next, let me move on to the core building blocks of an investment system. Okay, now a system, when we talk about investment system, okay, a system is actually not here to guarantee profits. Now, and this is very important because in investment, this is very important. And I wanted all of you to have this mindset when you go into investment. There's no single system in the market that can guarantee profit for you when it comes to investment. Okay. Now, why I want you to have this kind of mindset? It can save you from two things. First, it can save you from scam. Because what? When it comes to financial or investment scam, you often see people offer you, hey, I can guarantee return of 10% every month. Okay. Now, when you heard about guarantee return, okay, don't even think about how he can do it. For sure, this is a scam. Okay. Because there's no single system in the world that can guarantee profit for you in investment. Okay. Nobody, not even Warren Buffett can guarantee you, hey, this year I'm sure making 20% one, 30% one. No one, not even Warren Buffett. So there's no single system that can guarantee profit. And to save you from that, right? First thing, to save you from being scammed. Secondly, it's also help you to have the right mindset when you are planning for your investment portfolio. Because remember one thing, your investment portfolio is not 100% stocks. Sometimes you encounter advisors, unit trust agent to offer you some good products, in the market. So if you understand the idea of nothing is guaranteed, in investment, when these advisors or this agent wanted to sell you, hey, you know what, this fund is very good, and it's likely to make money, I can tell you that the profit is guaranteed one. Okay, now when this agent sell you this kind of thing, and you have the mindset saying that, okay, hey, I remember, I went on to this Busa webinar, George said, there's no single system that can guarantee profit one. And when you have this kind of mindset, right, you start to question back, hey, how do you know this fund is guaranteed profit for me? You will start to throw question. And when you start to throw question, you are somebody who understand about the products. Then these advisors or agents or whatnot, right, they can't, joke around with you. They need to be serious with you. They need to tell you the truth. Oh no lah. So this unit trust, or these funds, is actually invest into this, or this ETF invest in this. So what I think that it could be, the market might be beneficial of it, but there's nothing guaranteed, guys. All right. So similar here. Okay, what I'm going to share with you to build the system for yourself, right? It's not here to guarantee profit for you, but it's here to help you to reduce some random behavior that we as an investor we have. Sometimes emotion just kicks in, and I think, shouldn't buy this stock. Then you go and sell, right? Or when the market is bad, why should I invest that time? Then your emotions start to kick in. Then you start to do wrong decision. You see, so a system is here to help you to reduce all these random behaviors that we might have, and a system will tell you what to buy, why you are buying, how much to buy it, when to review it, when to reduce or when to exit or when to take profit of the company, right? And this is what the system will tell you. And without a system, all your decisions will become emotional. And this is really important. Now, let me share with you the 6 core parts of a personal investment framework, or what we call a system. Okay. And remember again, a system does not guarantee profit for you, but it helps you to reduce random behavior, right? Now, the first part of it is your investment objective, Secondly, the stock selection criteria. What is the criteria that you have to select the stock to be in your watch list or to be in your portfolio? What is your entry approach? What is the position sizing or the asset, the capital allocation to a single stock or a single product? What is the sizing, and what is the risk management measure you have, for your investment framework? And last but not least is when to review or exit for the investment. Okay, now let me move on to the number 1, your investment objective. I think sorry, this is not about the objective. I'll just jump into the stock selection criteria. Decide what qualified for your watch list. Because when we do investment, last time I always know, when I learn how to do research on a company, and a lot of people say, okay lah, you need to review everything. And when they say you need to review everything, that means the entire annual report with the financial highlights and all the financial reports, you have to read everything. And I tell you, I did that, right? I read everything from their profit and loss statement, their balance sheet, to their cash flow statement, to their statement of equities movement and whatnot, right? We study everything. Then we realize, to actually filter the companies, because when you study everything, then after you study, this stock is not suitable. Then you study the second one, the third one, without having a filter, right? So for me right now, when I do research or analyze of a company, I often will have some filters, and it's not 10, 20 filters for you to filter out all the companies, right? You only need to have about 3 to 5 sensible filters to help you to improve your decision. Now, let me give you an example. Okay, some of the selection filters are not a finalist, and definitely not my only list. Okay, but I'm here to share with you some of the selection filters. For example, you filter based on their business model or their revenue model. Maybe you are somebody who likes, invest into companies that can their revenue come from recurring business, or you are somebody who like their business come from one-off clients or whatnot, right? Different business model, different revenue model. So this is one of the filters that we might have. The second one, maybe we filter from the management group, the business growth of the company, or the milestone or the achievement that they wanted to achieve in the next 5 to 10 years. Whether they have a master plan, some action plan for them to achieve that, we need to filter that out as well, right? And thirdly, we also sometimes I also filter out, the director's profile, whether this director is actually somebody in the market or they are experienced in running the company, right? That's very important. Um, Let me give you some scenarios here. If you're going to invest into a tech company, a tech company, yet when you look at the directors, maybe one from marketing background, another one from F&B background, another one from oil and gas background. Nobody have technology background. Do you think this is a good profile for a director to run a company? Yes or no? I mean, in this scenario, do you think it's a yes that, doesn't matter lah, so long the company is doing good, then it's good ma? You know, no, right? Okay, I start to see answer, right? No, because we wanted to know that, this director has the experience to run the company because he is from the industry background, etc. Right? Now, this is the one scenario. If let's say I give you a comparison per se, right? The similar company that I mentioned just now, compared to another company also in the technology field, where the directors, they are all technical programmers and engineers with tons of experience in the industry. If I present to you these two company, A and also B, A being the one that the director is from different background, while B, the director are all from the same similar background, with the same valuation, with the same financial forecast and everything, would you choose A or would you choose B? Okay, A or B? Okay, now a lot of you say B. Wow, see, so the director's profile is very important. And since we are already at the director's profile, why not we also look at their remuneration? Now, how much they get paid every month or every year? Because this is also affecting, the valuation or the profit of the company. If the director take a lot of salary out from the company, right? Now this is also very important. Now, number 4, I will also filter out some of the financial numbers, right? Some of the financial terms. For example, is the company's growing on the revenue level, or is the company growing at their earning per share level or their profit level? Uh, has the company improved on their gearing ratio? Are they too leveraged or are they over leveraged? Okay, and the return on equity. Is the company having a good ROE or having a bad ROE compared to their peers, or compared to their historical performance? Now, these are some of the filters that you might need to have, before you actually qualify the stock into your watch list. Okay, and this is very important. And how much should you put into one thesis or one idea of stock? Now, this come to the positioning, right? And in our investment portfolio, it's very important that we have a positioning or asset allocation, because you don't want to have a single counter or single assets that hold 70% of your entire portfolio. You don't want that to happen, right? And because why? Now let me share with you why we don't want to have a single company or single stock or single asset class to be the 70% or 80% of your investment portfolio. Imagine that, for example, this 80% you invest into a single company, a single stock. Okay. Or the rest 20% you invest into 5 different stocks, for example. And then one day, this market is not doing good for the biggest position you have. The industry, maybe it's not good. Then it dropped by 10%. Okay, for example, it dropped by 10%. While your other 20% at different industry, they are at a very good time right now. And this 20% of your stocks portfolio improve and you get a good ROI. Now, let me do some let's do some calculation here. If let's say the one that you have the largest portion, 80%, drop by 10%, okay, drop by 10%. How much is the total return or loss for the entire portfolio for that portion only? Is 8%, right? 80% of it drop by 10% is 8% of your entire portfolio. While your 20% portfolio doing very well, averagely they get about 10% per 10%, returns. But ended up when it contribute back to your portfolio, it's just a 0.2% kind of thing, right? So when you do the calculation and say, hey, I'm still making losses. And that's because you are not doing well in your allocation of your positioning or your sizing. Now that's very important. So how much should we put into one idea? Okay. For example, if this is a very core idea, this is the idea that fit all your investment thesis, then you can have a larger allocation. For example, 20%. 15%. While those you think that this is more on the higher risk ideas, we are still speculating whether the project will get it, but you wanted to have some position first. Then this is what we consider a higher risk ideas. Then you need to start with smaller allocation because you don't want to risk your capital into something that you don't really sure how it will perform. Okay, and one thing I wanted to highlight here is also never let one bad decision destroy your portfolio. So please make sure when you do investment, this decision is not a bad one, which means that you don't want to have something like what I mentioned just like in that scenario, right? You don't want to have the stocks, the single stock be the 80% of your portfolio. If something happens, then your entire portfolio will get destroyed, right? And next, I would like to share with you, okay, one of the system that I use to to identify, not identify, to structure a portfolio for ourselves, in allocation parts. So I always tell people when you do your investment portfolio, you must have these 3 elements. Okay, not 3 elements, these 3 category. The first one, so the system is called diamond system, right? So why diamond? Because this is the structure of a diamond. We have a crown, we have a depth, we have a cullet. And these 3 actually stand for different things. I'm not sure how many of you is a jewelry guy or who somebody who understands jewelry or a crystal or diamond. I'm not that kind of person, but I know lah. The crown of the diamond is actually for our visual appeal. To look at it to see how nice is the diamond. Now this is the crown. And the depth is actually for the brilliance and also the sparkles. So whatever you see from the crown is actually the reflection of light in the depth, inside of the diamond. And the cullet is actually the bottom of the diamond, which is to prevent damage to the entire diamond. Now, when you translate this diamond structure into our investment portfolio, somehow it is very aligned. Because for our investment portfolio to be safe, you need to have quality protection, So you need to have something like low risk investment while still get some hedging against the inflation. See, so you might have money market funds, some dividend stocks, good quality dividend stocks, or you invest into fixed deposit. Now, this is the quality protection or bonds, you see. Now, this is quality protection. Now, then steady growth is something that just like a crown of diamond. This is for us to safeguard the entire portfolio, the core of it. So you need to invest something into more steady growth. For example, you invest into banking stocks, financial institutions, some other industry that give you steady returns or steady growth across years, right? Now that is for the steady growth. And the last thing, how do you know that your investment portfolio might perform better compared to last year or compared to last month, right? It's all come from the high growth category. Maybe you invest into some undervalued technology company, okay? Or you invest because you think that your thesis is very good, but it's yet to be justified by the market. Then you put it on into high growth category. And this is the diamond system or the portfolio system that I use, for not only myself, but also for my clients, for my students, is that you need to have all these three. But how to allocate it is all depends on you, your risk level, your your goals, your time horizon. They are all different. So for you to have this system, and then you can know like how to plug in the numbers. For example, you think, oh, I'm a high risk taker, I go for a lot more in high growth, but you need to always have the quality protections, right? Then last is to review and also to exit. How to review, how to exit, because a lot of people, they know how to do investment by buying into the stock, but they don't know when to sell the stock. Now this is very important, and because as an investors, our returns only realize when we sell off the stock. Am I right? Or you get the dividend returns. That's it, right? So selling is also part of the system. How and when we should sell the business or the company or the stock. So during the review sessions, right, we need to always review back on our investment thesis. Why I invest into this stock? Then what happened right now? Okay, so you need to ask yourself a few questions. First, has the business thesis changed? For example, you study this company has a bright future. Suddenly, the management thinks that, oh, we want to pivot into another industry. Then you don't have a clear data of how good is the new future venture that will bring the value to the business. We don't really know, right? So when this kind of business thesis change, then maybe it's a time for you to exit from the company, right? Now this is one example. Or secondly, has the valuation become too stretched? Okay, if let's say for example you monitor this stock and you are looking at their very best undervalued price, and you luckily you get it. Now you got it, and then you enter into the position, you hold on to it, you add it into your portfolio. After 1 year, 2 years, a lot of people identify this company, they start to invest in, they push out the price and all that. Then your valuation will get stretched as well, right? Because when the time, maybe your invest time, the PE is only 20 times. Then after a lot of people wanted to invest in this stock, drive out the stock price and all that, the PE suddenly become 50 times, 100 times. So will the valuation become too stretched for you to, is it time for you to sell it off? I think that's very important. And last but not least is, has my risk profile changed? Okay, now this is very important. You are not always a conservative investor, and you will not be always an aggressive investor, because your age will change. You will grow over time. Your time horizon will get shorter, when it comes to your goals. So it's very important to understand that if your risk profile has changed from aggressive to maybe a moderate or conservative investors, then your investment portfolio might need to be changed as well, right? To fit into your risk profile and also your investment thesis, right? And that's very important. Okay, let us move on to the last part of our today's sharing, is to build your own framework. Okay, now when it comes to build uh investment portfolio or the framework for asset or structure, these are the 5 things, right? First of all, what is your goal? What is your style? What is your focus? What is your positioning? What is your review? And these 5 has been explained in my early sharing, right? I teach you how to set your goal, how to know yourself, what is the different style of investment or versus trading, what is the focus. If let's say you are going to do some trading or some investment, what is the focus, right? Is it a price, is it a candlestick, or is it a business quality? And positioning, like the diamond system, how do you allocate your position? like holding how many percent into your high growth, how many percent in steady growth, how many percent into the quality protection and whatnot, right? And this is very important. And last but not least, to review your entire portfolio, right? And to build your own investment checklist as well. And a lot of people actually didn't do it, right? But remember when I said you need to understand your criteria, the stock selection criteria, try to make it a checklist as well. Okay, you can have as much as many as possible that you want. Right? For example, do I understand this business? Tick and then put down the business that you understand about this company. Why am I buying it? Okay, list down why you are buying into this company. Write yourself a thesis, right? Write yourself a review. Why you are investing into this company. And third, what is my time horizon for this position? Do I want to hold it for 3 years? Do I want to hold it for 6 years or 10 years? And for what purpose I wanted to hold on for it? Okay, and does it fit my system? And this is very important because when all the stocks that you have selected, you want to know, is this stock fit to my system that I have built? If it's not, then so sorry, you can't, and you don't want to have this stock into your portfolio as well. That's very important. And always have the risk management mechanism in place where you need to also understand what could make me wrong. If this company, after I do the valuation, I do the analysis on that, and it's too good to be true that wow, this company really at undervalued price. What could make me wrong? You see, I give you an example. What could make you wrong? If this company is truly so undervalued, then nobody is seeing it, and you found out, yet still nobody wanted to buy into the companies. Then there might be something wrong. There might. Okay, it's not always that you are wrong when people didn't identify it. It's not always that. You might be wrong if the company is too bad, or the bet is beneath the number, which we don't see it, we can't really see, we don't understand it, but there's something changed in the industry, but we don't have the data or we don't have the insights. That could make us wrong as well. So we also need to have this kind of what we say a risk management mechanism, where you would try to justify for yourself. Okay, now I might be wrong at this level or at these kind of these parts that I might be wrong. Then you wanted to make sure that you get the right data or get the right research to justify for you that, oh no, I'm not wrong. So this is where the company is going to grow, the industry is going to grow and whatnot. Right? This is very important. Okay, so this is some checklist that you can have, for your investment portfolio and your framework. And here are also some of the common framework mistake that I must share with you. First of all, too many complicated rules. Don't be as easy as possible, because we are not research house, we are not investment banks. You're not invest for others, you invest for yourself. So you don't need to have the investment bank level of rules. When you invest into a company, you don't need to have that. And that will cut down the rules and make it less complicated and make it more easy, make it easier for us to do investment. And secondly, no review process. A lot of people, when they start to do their investment, they don't review anymore. Then when they review, they review when they wanted to sell, and when they wanted to take out the money. Then they start to review. Hey, why did I invest into this company 2 years ago, 3 years ago? Then there's no review process one. Then if after 3 years, then only you realize, oh, I'm making an unrealized loss of 50% of this company. Maybe the investment thesis has changed 2 years ago, but you didn't identify it because you didn't do the review properly, right? So that's a mistake also. Don't do that mistake. Yeah. So do your review at least quarterly or half yearly, every year. Okay. And the third mistake is to copy someone else's style. You remember what I said just now, right? Everybody have different personalities, so don't copy others' investment style. Find your own investment style and keep on with it. Okay. And don't always change your strategy every week. Okay. And what kind of people will always change their strategy? Is that he invests listening to this friend saying, hey, do fundamental analysis, very good. You must do fundamental analysis. Then he said, okay, my strategy now is to do fundamental analysis. Next week or 2 weeks later, he met another friend. Another friend tell him, hey, you in this market, you should trade. I cannot hold on to long-term one. Then his strategy changed again. I'm not investor now. I'm a trader right now. So I trade the market instead. I do investment. I need to change my portfolio. If you're this kind of investors, then you are keep on changing your strategies week by week or half every month, then I will tell you, don't invest at all. Try to figure out what you want. And try to go back to my early slides, find out what is your goal, what is the time horizon, what is your personality, what is your style. After you fix that, you have some draft idea of, okay, this might be my strategy, then go on with it and be long term with it. Okay. And last but not least, having rules but not following them. Now this is very important. A lot of people having rules, they have a lot of rules, but the rules is just there for reference only. Okay, I can give you an example, a real life example. When we go to a restaurant, you wanted to order, then they will give you a menu, right? Then they'll put some very nice illustration of the food. Now this is B1, nasi lemak ayam goreng. And then they will tell you that there will be a remark there. This is for illustration purpose only, right? And a lot of people, when they start to do investment, they listen to all the sharings and whatnot. Then they have the rules. They have the criteria. Wow, this is my stock selection criteria. And all these checklist criteria and rules are for illustration purpose only. So he just hang it there. But when he do investment, he didn't follow anything. He follow his friend. This stock can buy, he go and buy. Now, I don't want you guys to make these kind of mistakes, okay? So please don't. After today's sharing, build your own framework and your own strategy, okay? And from variable to discipline, the market, I can tell you, market is very fair. And to invest, having so many technical rules and also checklists is not going to help you to make money as well. Because when you start investment, that emotion will kick in, like I mentioned just now, right? So market will test your emotion. Okay, so that discipline is very important, because when the market tests your emotion, you know what you need to be what need to be done, because you have a discipline, you have a rules, you have framework to protect it, right? So that's very important. Okay, and last but not least, how to improve over time. When we do investment, we need to improve it, right? So here are some tips for all the investors here. Start simple. Okay, don't always go with a very fancy kind of valuation. When you start doing fundamental analysis, go with the simple valuation model, the PE model. That's it. I think that's the simple PE comparable, just compared to the peers and whatnot, and to compare to the historical PE. I think that's good enough for a beginner to start with, right? Don't go with the fancy sum of parts valuation, then there's DCF valuation, and whatnot, right? DDM, dividend model, don't go with that, right? Just go with the simple one will do. And then always track your decision. What I do, last time, back then, right now I don't really do it much because I don't really invest a lot. When I have more investment, a new investment thesis came out that I wanted to invest into the stocks, I will have a PowerPoint slides, to have a saying that, okay, this what stock is this? What is the business model? Why I invest into it? What is the future growth, right? When I need to review it, I have a PowerPoint slide, just for one company. I used to do that. So you need to also track your decision. Okay, after you have that, right, always review every 3 months or every 6 months to see whether if the company performance or their growth is intact with our analysis. That's very important. And not only to track or to celebrate all the wins, we need to always review on our mistakes as well. And that's very important, because we do make mistake, right? Even until today, during investment, I will also make mistake one. Okay. And then we need to improve our framework gradually. Okay. Always improve the framework time by time, and let our experience refine the system. Okay. When you do more investment, you have more experience in the market, then you know what to improve in your system. And that's very important. And not let your emotion to decide what your system gonna be like. Okay. And I think that's wrap up my sharing today on the trading versus investors and how to build an investment system for ourselves. Right. And trading and investment are different approaches, but they are not enemies. You can still have both of them in your portfolio, a mixture of both, just to make sure that you know what to do with them. And a personal investment framework also brings structure and also clarity to you. And if it doesn't, then you are building a wrong investment framework lah. Okay, so after that, after today's sharing, I hope that you can have a more structure into your framework, and you have more clarity with it. And I hope that you can make a good decision with your investment. And discipline, now this is my last word for you. The discipline turns a framework into results. So you need to be more disciplined when it comes to investment, and this is very important. All right. Then I think we can go on with the Q&A. But after this webinar, okay, while I invite our moderator, Michelle, to come back to host the M&A, the Q&A sessions. After this, if you haven't defined your investment goals, go back, write down your goals. Try to define it. Write down some investing rules that you might have. Build a simple checklist for you and start reviewing any of your investment framework that you have. I think that sum up my today's sharing, and let us move on with the Q&A session. Shall we?
Okay, let me share my screen first. Okay, so thank you, Mr. George, for your wonderful sharing with us. We will now proceed to the Q&A session. If you have any question, please type them in the Q&A box and I will address them accordingly. So, Mr. George, for the
Yes.
first question, it is stated that I am 16 this year. Would you suggest that people who are young like him or her to take as much risk as possible to gain the most capital to build a passive income system in my 20s to retire around 30 to 40s?
Okay. To answer to Eason, you're 16 years old this year. Congratulations, you're very young. But so sorry you can't actually open an investment trading account in Malaysia yet. So I think this is the time for you to actually start learning, Eason. But my suggestion will be don't take. Okay, because you're asking young people, should you take as much risk as possible? My answer is no, because there's nothing saying that you are young then you can take a lot of risks, right? Because your personality might be different. I've seen somebody who are at their 20s, but their risk level is those who are at their 40s. That means they are very conservative kind of people. Uh, and if you're looking at me, right, I have defined my own investment, approach 6, 7 years ago. I have defined, what is my investment strategy and what is my style. And I understand that myself is also not aggressive investors. So I cannot take a lot of risk one. For me, I consider myself as a moderately aggressive, not too aggressive because I cannot take a lot of risk. So back to your question, I don't think I would suggest you or any youngster like you to take as much risk as possible, but I want you to understand your risk profile and to understand what is your goal. And if your goal is to build up more capital to build a basis income system for yourself in your new 30s, 40s to retire early, my second suggestion to you will be to build more income stream. And when you are young, because you have a lot of energy, you can do a lot of things, then try to build more income stream and then build your investment portfolio along the way. Then that might make more sense, and you might see a better result from there. So that might be my answer to Eason. Okay.
Okay, thank you, Mr. George. And for
Yep.
the second one, this person stated that I graduated in 2024 and started working in 2025. I've worked for 2 years. For now, I only start investing retirement program that only give 3 to 4% return. However, I want to try investment using new tools. What can you suggest me to do for now?
Okay. Good question from Hui Ting. Okay. I have a question for you, Hui Ting. You can write it down and then try to see whether that fits for you, right? Why do you only invest in retirement program? I'm not really sure what is retirement program. They only give you 3 to 4% returns. Is that because of your risk level? Maybe you you don't really know about investment in stocks. That's the reason that you don't really invest into it. I don't know, right? You need to answer it yourself, right? So if let's say your answer is okay, you say yes, so maybe you are a conservative investor because you don't really know about stocks, so you don't dare to take the first step, right? And now you wanted to try, for example, you wanted to try to invest in stocks. My suggestion for you now, your next action plan will be to learn about it first, because when we have knowledge or we have experience or information about the asset classes or the investment tools, it reduces your risk level because you understand what you're doing, right? So for you now is to learn more investment tools, for example, stocks, how to invest into stock, how to do research, how to do fundamental analysis, how to do technical analysis if you wanted to be a trader, right? So from there, try to find out whether these investment tools is something that you are comfortable with. Because I cannot say, okay, I want you to go and study what this stock about. Then you go and study. Then you find out, wow, I really cannot invest into stock. I cannot sleep at night one. Then you don't go hard way lah. You don't go, okay, I cannot. But now George tell me, I need to 3 to 4% return is too low. I need to go. Then you go into investment into stock market, but your risk level cannot take it. Don't do that, because you need to align your goals uh with the investment. So you need to find out what are the investment tools that fit with your risk level and your goals. Okay, because from your question, I understand that 3 to 4% is not something that you're looking at. You're looking at something more, but beyond that level, you don't have confidence with it. So try to learn about it first. So that will be your low hanging fruit. Just try to learn about it. Then from there, make your decision whether do you need to start invest into stock market to try out. Then do your own research, have your own thesis and one. I think that's make more sense for you to move forwards, right?
Okay, thank you for your answer. The next question, what type of companies grow steadily over time?
Jack, I also hope I know that. Uh, well, I can give you some example, I can give you some example. Okay. I know the answer. Okay, I know the answer, but I wouldn't say, okay, if you're asking me what kind of industry or what kind of company was, what type of stocks, right? I don't really have an answer here. But what I can tell you is that back with my experience, I've invested into companies uh that make me return more than 100%. I think I have 3 to 4 stocks that make me that kind of returns. And what I did correctly, okay, I just share with you what I did correctly with the selections, and I think uh that will give you some insight, right? First of all, I invest into companies that have futures. And when I said they have futures, it's not only on their theories, it's also on their papers. That means their revenue is growing, their earnings is growing, the industry is growing, the business quality is growing. And when you met this kind of business at a very fair valuation, or even if the market is so good that you are at the undervalued times, right? Then that's the company that can grow steadily. But I can also tell you, after I review all these stocks back, from today, or after I exit the position, then I review back the company, the stocks. Some of the company didn't grow better after we exited, or after I exited the company, the stocks. And that made more sense because, like I mentioned just now, there's no single company in the world right now, I think, that they could sustain for 10, 20 years, become as a leader. Not even Apple, right? Apple, the iPhone, we have a lot more challenges, Samsung, Google, they're getting better with that. Tesla, we see a lot of car companies are coming out, like BYD. Come back to Malaysia, uh, you don't see, for example, Maybank, but still a lot of, competitors, the CMB Bank, Hong Leong Bank, Public Bank, they're doing better. RHB Bank, they're going up, right? So we don't see a company that will all forever stay as a number one in the market. I don't really see that. So when we do investment, then if you want the company to grow steadily, then you look for the criteria that I mentioned just now. And very importantly is to study the business very well so that you understand the industry, you understand the growth thesis, why they are growing, what they need to do right in order for them to go further. And that's very important, because after you know the answer, when the company is not going into the right way, then they might fail in their expansion or whatnot, right? So that's very important. I hope the answer for Jack to find those company they want.
Okay, thank you for the answer. The next one, how do you react when nothing happens after you invest?
Okay. Okay, my true answer to you is that how will I react? Well, the first thing I will go and revisit my investment thesis. I find out, did I do something wrong that I didn't notice back then when I invest into the company? This is the first thing. Secondly, I will do is that I will see what is the market condition, because if nothing happened, there will be only two scenario. I would say only two lah, but two major scenario will happen if the market didn't react. First of all, this company doesn't have a lot of exposure. There are a lot of people didn't know about this industry, or the industry is just so uncommon that it's not a common hot topic at the market right now. Then for sure nobody will talk about it. Then secondly will be if there's something that a lot of people know that I don't know, right? Then I need to revisit back to my investment thesis again. So that's what I will do lah. If the market didn't react the way I expect it to be. But as I said, investment is long term. So it's also depend when do you revisit, or when, what's the time frame when you say that the market didn't react. Maybe you invest today, and then after 1 month you see a market didn't react. If 1 month, then I would say it's too slow lah. I mean, it's too quick for us uh to go and visit whether our investment thesis is right or wrong. But if let's say you think you are saying that, okay, I revisit after 1 year, the market didn't react, then yes, you need to revisit again your investment thesis, or you need to review back why we invest into the company at the first place, right? And that made more sense, right? So I think that's more of my experience to share with you, Jack.
Okay, so for the next question, if the IPO is oversubscribed, will you buy in when a lot of people chasing in?
Okay, very simple answer, no. Okay.
Okay.
No is because I don't really invest. I don't really join. I don't like to join the hype. When the IPO is oversubscribed by a lot, and then people just go in on the first day, the opening hour, just buy. I don't really like it because, like I mentioned just now, it is not my investment style. So different people, you have different style. All right, it's just not my style. Okay, doesn't mean it's wrong. It's just not my style.
Okay, so for the next one, do you reinvest profits or keep them as cash?
Wow, that's a very good question. I keep them as cash. Uh, but it depends. Okay, it depends because sometimes when I uh take profit from the investment that I made, right? I don't always take full profit. So sometimes I take partially profit. So when I take partial profit, then I keep them as a cash so that I have more capital to invest into my second or third investment thesis or investment that I wanted to invest in. And also to make sure that I don't have the single counters or single stock in my portfolio that is beyond the size that I wanted it to be. Right. So that's very important.
Okay, the next one, how do you react when a stock suddenly drops after you buy? Will you sell it immediately or keep for long term?
Mm. I think I think based on my sharing just now, you guys know what I will do. Okay, when a stock suddenly drop after I buy, I will usually, as I mentioned just now, I will revisit it and then make sure that nothing changed. If there's nothing changed, I will hold on it for long term, because maybe it is the market that make this stock so volatile. Okay, or maybe the company fundamental has changed. That If that happen, then I might revisit my position again. Then I might want to cut loss, right? But if nothing happened to the fundamental of the company and the share price drop is just purely because of the market condition, like for example, when the US and Israel uh, hit Iran, now this kind of war happened, everybody panic. But will this impact to the fundamental of the company they invested? Not necessary. So we always need to revisit, right? So I think that's the right way to do lah when the market or the price of the company drop a lot.
Okay, Can you share with us how do you tell if a company is growing long term or just temporarily?
Wow, that's very good question. Uh, we can tell. First of all, experience matters. So when you have more experience researching of a company, then you know more. And secondly, I think if we wanted to know whether a company is there to grow for long term, it really depends on the numbers and also of the growth plan or the industry that they are in. So it's not a single element, but also multiple factors that impact the uh, growing factors of the company for long term. So we need to study a lot of things. For example, how well will this industry grow? How well will this company grow? How well will what is the numbers showing that this company is growing and whatnot, and multiple things. So like I mentioned just now, your stock selection criteria, that's very important.
Okay, the next one. What emotional mistakes happen more in trading versus investing? How do you control them?
Okay, your after you invested into stocks, your first emotion that will kick in will be your panic when the share price drop. So one of the mistake a lot of people do, they will sell during the panic hour. That means they will you have a panic sell, and this is one of the biggest mistake a lot of retail investors did. And this is something that you after today sharing shouldn't do it. Don't panic sell, because when the market, I can give you an example lah, just some recent incidents last year when the US President Donald Trump announced the tariff across the world, all the stock market dropped, and I can assure you all your position will be in a negative performance as well. And if your emotion kicks in, oh no, the market is in a downturn right now, it's in a bear market, then you go and do your panic sell. Congratulations, you have fall into the trap. 2 months later, 3 months later, the market start to rebound, right? And that's what happened in the market. So don't panic sell. And this is one of the biggest emotional mistake that a lot of people will do. And I can assure you, I also have this kind of mistake back then. And then what I understand is that market is always like that, because in short term, market is always volatile. Because without volatility, there's no room for trader to earn their money. So there will always be volatility, because trader and investor, they are living in the same world, right? So that's really important. And when we understand this kind of mistake that we might do, always tell yourself when the market is bad, always tell yourself, don't panic sell, revisit it, see whether, so like I mentioned just now, discipline matters, because when emotional kicks in, your discipline will be the barrier to protect you from making mistakes, and that's really important, right?
Okay, for the last question, regarding asset allocation between steady growth or high growth or quality protection, what is the typical allocation like for investing for passive income, reasonable return of 8% annually? Any such asset allocation?
Okay, now Kennedy, thank you for your question, but because I don't really know uh your profile, I couldn't give you a direct answer on this, right? What I would say is that there are some rules to look at it. For example, there's a rule of 100. Just take 100 divide by minus your age, and you know what is the allocation that you can invest into some high growth element. Now, this is some of the rules, or some of the I would say formula that a lot of people use, back then when they wanted to invest into high growth versus the steady growth versus their quality protection. Um, it also depends. My second way for you to do the allocation design for your own self is that you use a reverse engineer method. Okay, for example, you're looking at the investment portfolio return of 8% per annum. Okay, now just do some simple math here. If you say you're looking at 8% for your entire portfolio, and when I mentioned you must have quality protection. So for example, you are somebody not so conservative, you only have 10% in your quality protection. Example, quality protection, you might invest into bond, invest into fixed deposit, money market fund. Let's put in 3% per annum return. 10% of your portfolio with 3% return is 0.3%. And you need to use the rest of the remaining 90% of your portfolio to earn the 7.7% return for you. And that you need to split into high growth and also steady growth. So for example, your steady growth is somewhere around 8% per annum. Let's say expected return 8% per annum. Then let's say you put in the steady growth at about 30%. Okay. 8% return at 30%, this give you about 2.4%. Now 2.4% plus the 0.3%, your entire portfolio without the 60% at high growth is at about 2.7%. That means the 60% of your investment portfolio must generate enough for you to earn the, how much just now we mentioned 8%, right? You need to have about the 5.3% from your 60%. So you need to see whether your high growth can meet that 6.3% of the 60% portfolio. Makes sense. Can understand the calculation. I hope you can understand the calculation, Kennedy, because I don't have anything to show you. So I just use my brain, just do some calculation myself. So that's the idea of how we can reverse engineer back on how we want to allocate our investment portfolio, and that's very important. And I always use this kind of method to reverse engineer to find out whether our investment portfolio is the allocation is good or the allocation is bad. I think this make more sense. Okay, I hope that yeah, work backward. Yes, thank you very much.
Okay, thank you, Mr. George, for answering the
Yep,
question.
thank you.
Uh, Thank you very much to everyone for taking the time to attend the webinar today. We will also like to sincerely thank Mr. George